Well, if Trump can force it, the Federal Reserve will almost certainly respond by lowering the federal funds rate in an attempt to stimulate the economy. That's their primary tool to encourage borrowing and spending when economic activity slows down. When the Fed lowers the federal funds rate, it becomes cheaper for banks to borrow money, and in turn, banks lower the interest rates they charge to consumers on loans. While mortgage rates don't move in direct lockstep with the federal funds rate, they are heavily influenced by it. A drop in the federal funds rate usually leads to lower bond yields, which in turn pushes down mortgage interest rates. If this happens, home buyers could see mortgage rates fall back into the 5% range or even possibly lower and quicker. This would set off a chain reaction in the housing market, affecting buyers, sellers, and investors in different ways. For buyers, this would be a game changer. Mortgage rates have been one of the biggest hurdles over the past 2 years, significantly increasing the cost of home ownership. If rates drop, affordability improves, making it possible for more buyers to enter the market. A lower interest rate means a lower monthly payment, which can make a huge difference in whether someone can afford a home. For example, on a $500,000 home with a 20% down payment, a mortgage at 7% would result in a payment of around $2,660 per month before taxes and insurance. If rates were to drop to 5%, that payment would fall to about $2,147, saving buyers over $500 per month. Those kinds of savings can make the difference between sitting on the sidelines and actually getting into a home. The challenge, however, is that lower rates will bring back more competition. Many buyers who have been waiting for rates to improve will jump back in, increasing demand. If people are competing for homes, prices could start to rise again. That means that buyers who wait too long might find themselves in bidding wars or pay more for a home than they would have if they had acted earlier. Another factor to consider is job security. If a recession leads to job losses, some buyers may hesitate to take on a large financial commitment, even if mortgage rates are more favorable. But knowing that unemployment is higher than what they are currently saying, those that are educated shouldn't panic. Evaluate your job for how recession-proof it is and make your decisions wisely. For sellers, this shift in interest rates could bring more activity back to the market. One of the biggest reasons homeowners have been hesitant to sell is because they don't want to give up their low mortgage interest rates. Can you blame them? Many people are locked into rates around 2 to 4% during the pandemic and do not want to trade that in for a much higher rate. But if mortgage interest rates drop, the hesitation to move could ease.